And so what we're arguing is we think they've had a year of time to go ahead and kill it, but they couldn't. Instead, you've oscillated either side of 33 with two peaks at 35. We think that the momentum picture says, no, it's too old. You're not going down. You've been going down for a year. You're ready to turn and go the other way. So I think the real shocker here will be silver, not so much gold. Yes, gold has gone into price acceleration, while silver's built this pattern on momentum that says, I haven't even begun. We're keenly watching the silver-gold relationship, because when that breaks out, it's never a situation that you have that gold is going down more than silver and silver's holding, and therefore silver's appreciating versus gold by not going down as much. It's always a situation where silver's going up much more than gold.
Gold has experienced a remarkable upward trajectory over the past 12 to 18 months, far surpassing expectations and consistently outperforming key technical indicators such as the 200-day moving average. While the metal's rise during much of this period was relatively steady, characterized by slow and incremental gains with periodic pullbacks, the last few months have marked a significant acceleration in gold's price action. This acceleration has been particularly notable as gold has broken through several crucial technical resistance levels that previously constrained its growth. As a result, gold has now entered a phase often referred to as vertical, where the momentum for further price increases seems to be intensifying. In contrast to gold's steady upward momentum, silver's price action over the past year has been more erratic and unpredictable. While it spiked to nearly $35 in October 2024, silver has struggled to maintain consistent upward movement, fluctuating within a narrow range of $32 to $33. Despite these fluctuations, analyst Michael Oliver suggests that the current corrective phase may be nearing its end. He believes that if silver can break through the $34 to $35 level with sustained momentum, it could trigger a significant rally, similar to past explosive price movements under similar market conditions. This suggests that silver may be on the cusp of a breakout, setting the stage for a substantial upward shift in the near future. One of the critical factors influencing silver's future performance is the gold-to-silver ratio, which provides insight into the relative value of both metals. Currently, silver is trading at approximately 1% of the value of gold, a historically low level that suggests the metal may be significantly undervalued relative to gold. This is a significant indicator, as periods when the ratio falls to such low levels have often been followed by significant price rallies in silver. Michael Oliver emphasizes that if the gold-to-silver ratio rises to around 1.1% or higher, it would be a strong signal that silver is on the verge of a major price surge. Such shifts in the ratio have often led to significant silver price increases, as seen in 2020 when silver surged while gold's gains were more modest. Now, we present the clips from Michael's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Well, actually, during most of that 12-month period, we started March of last year, so it's been a full year of upside. But really, it wasn't vertical. It was a lot of, like I said, laborious 3 steps up, 1 step back, go to sleep for 3, 4, 5 months. That process. It's only in the last few months that it's really gone what you would call vertical. In fact, you can even see it on price charts now. Momentum did it first, and then price, you could draw a line across the last year or so of upside, and there's like a rising line across the highs, and we popped through that a month ago, and we're still above that level, that acceleration level on price. So I think the acceleration in gold has just begun. But when you flip over to silver, they've been caught in a range with a high at 33 back in October of last year, May of last year, and dropped. Then in October of last year, they went up to 35 and then dropped again, but it was a higher high. And then this March, they went up to 35 again and dropped and cleaned everything out. And now we're trading in the 32, 33 zone. We do a momentum study of that price action, which you could draw a line. You go back to May of last year. It was a year ago, 13 months ago, and draw a horizontal line across the highs that we saw back in May of last year. You're diddle-dawdling on either side of that line. So silver's really not breaking down, but it is stalled with a horizontal line going through the ink over the last year, where it goes above it and below it, above and below it. But momentum during that time, long-term momentum, has had a corrective tubular decline. Price is horizontal, basically. Momentum, it's been a parallel channel that goes back a year. And whenever momentum develops something that clear, I define it with my hands here, but it's like a channel of action on momentum, but it's very old now. It's 1 year old of this process of correcting from overbought levels. Price has only gone sideways, net on balance, while momentum has had its full correction. You break out of that channel again on momentum, and you'll do it up around the 34-35 level using the front month silver, which is now July future. You go back up to those highs again in price, momentum will be breaking out of this massive channel. In other words, momentum will be saying, pounding the table, I'm starting again. So though it's been wild but boring for the last year on price, momentum has cooled off to the point where it's created a structure that if you break out of it, you're going to gush on the upside. And so what we're arguing is we think they've had a year of time to go ahead and kill it, but they couldn't. Instead, you've oscillated either side of 33 with two peaks at 35. So we think that the momentum picture says, no, it's too old. You're not going down. You've been going down for a year. You're ready to turn and go the other way. So I think the real shocker here will be silver, not so much gold. Yes, gold has gone into price acceleration, while silver's built this pattern on momentum that says, I haven't even begun. If you go back 50 years and look at the silver divided into the price of gold expressed as a percent, 1% is super low. So in other words, either it's going to hell and going to zero, okay, which isn't going to happen, or you're looking at a bargain. Because anytime silver gets down to 1% of the price of gold, look out the next 6 months or so and you'll see drama, okay? In fact, this happened. It got down to 0.8% the price of gold in that COVID sell-off. And in the next 6 months, silver went off the page percent-wise. While gold had a nice, like a 40-50% move, silver doubled in that 6 months. There is, when you plot the spread relationship, not just the spread itself as a chart, we also run momentum of the spread. And what we're saying is that spread now has gotten bound below the 1% level, and it's just marginally below it right now as we speak. You get back above about 1.1%. That sounds trivial, but when you divide this over into gold and you see it get up, have a weekly close at 1.1% or higher, it's a boarding out of this hole, and it's saying, I'm coming out of here again. And there's another level up at 1.3% of the price of gold, but if you go through that, the lid will come off. You'll gush to 2% in a heartbeat. Well, you say, 1% to 2, who cares? Well, that's a doubling of the value of silver versus gold. It's like buying something at 1 and it goes to 2, okay? So we're keenly watching the silver-gold relationship, because when that breaks out, it's never a situation that you have that gold is going down more than silver and silver's holding, and therefore silver's appreciating versus gold by not going down as much. It's always a situation where silver's going up much more than gold. So it's always bullish when silver-gold situation shifts into positive.
The consistent upward movement in gold prices over the past decade can be attributed to several factors, most notably the expansion of the global money supply. Central banks worldwide, particularly in significant economies like the US, the Eurozone, and China, have significantly increased the amount of money in circulation. Over the past 15 years, the global money supply has surged by an astounding 200%, which has led to a diminishing value of fiat currencies, most notably the US dollar. This continuous inflationary pressure, coupled with the unstable financial environment, has pushed investors to seek more reliable stores of value, with gold emerging as a leading alternative. Michael Oliver suggests that gold, traditionally considered a hedge against inflation and a safeguard during periods of monetary uncertainty, has benefited from these broader systemic issues as people lose faith in paper currencies and turn to precious metals as a more stable option. Furthermore, the persistent weakening of the US dollar has intensified the demand for gold. As the dollar's purchasing power erodes due to the ongoing expansion of the U.S. money supply, concerns about its long-term stability as the world's primary reserve currency are growing. Michael Oliver notes that the dollar's strength has historically been a cornerstone of the global financial system. Still, rising inflation and a declining value cast doubt on its future. As a result, more investors are turning to gold, a finite resource with intrinsic value, offering a safer alternative to the fluctuations of government-issued currencies.
I'm not looking at that factor. It's an interesting factor. Gold's been going up for over a decade. And now in the last year, suddenly we have this China situation where everybody has turned their focus like China's buying, China's buying, China's buying. And they like try to report on it every week. How much did they buy? And in the other, we understand that just recently there was 1 million ounces sold, which isn't that much, in the bigger scheme of things, from Chinese, probably citizens, not the central bank necessarily. And everybody thinks that's all you get to watch. No, it's not. Gold moves on far broader trends in monetary degradation globally, not just U.S. money degradation, but global. I saw a report the other day that global money supply has gone up 200% over the last 15 years. 200%. Meaning the quantity of money has gone up, therefore the purchasing power, the real buying power of those money units has declined. And for the dollar, going back to the 1950s, every single decade, look at M2 and see it went from here to here, do the percent, and you'll see that it almost doubles every decade. And even more so recently because of what happened with COVID. Also, since the 2009 bear low, they did QEs. Don't be shocked if they go back and do QEs again. And by the way, the other thing I would be looking at in terms of what's the Fed going to do is not just the data points, the economic data points, because they're going to go sour big with the stock market. They follow the market. They don't lead the market down. Is the T-bond market. Something's wrong over there. Treasury bonds are normally another alternative place to put your money if the stock market is in trouble. And yet since the stock market dropped 20% from January to April and now has bounced, but the bonds haven't risen. They've tried repeatedly to rise in price, drop in yield. I'm talking 30-year bond futures, for example, not the short end of the market that the Fed controls, but the long end of the U.S. government debt market. It's a dog. Now, we even thought technically there was justification for T-bonds to participate with gold as an alternative to the fractured stock market. And we saw a nice surge. Back early this month, T-bonds shot up to 122 on the T-bond futures from lows down in the mid, 1-teens, 115, 114, et cetera. So there was a big surge in price and a drop in yields, but it crashed. T-bonds in 2.5 days went from 122 in price to 111. For T-bonds, that's a crash. That kind of percent drop, especially in 2.5 trading days. And since then, they bounced back up about halfway to that 122 high. And I think the best we've seen is about 117 or so. Right now, we're trading the 115s. I think even today, we traded under 115. So the T-bonds are lame. They're not functioning as they normally do as an alternative place for money managers to shift some money to avoid risk in the stock market. What's going on there? That is of great concern to the central bank and to the government itself. So don't just look at the data points. If that T-bond market doesn't start to behave, in a healthy manner, and especially if the stock market starts to go down again and you don't see bonds go up, whoa, what's going on there? Well, we know what's going on. The big fundamental is we have a government debt crisis. The question is, when is it going to occur? Right now, T-bonds in the high 114s, you don't want to ever see the nearby futures. It would be the June T-bonds right now, down at 111.5 again. We argue, you close a month down there, they're going to flush them. Well, that's what will panic the Fed more than will the stock market. So watch the T-bonds and the dollar as well, which is a crippled bear market as far as we're concerned.
Gold's surge toward $3,500 per ounce provides significant momentum for silver, which historically tends to benefit disproportionately when gold experiences substantial upward movement. For example, during the 2008 and 2011 bull market, silver outperformed gold by an astounding 400%, demonstrating the leverage effect silver can exhibit in similar market cycles. While silver often lags initially, it has historically delivered superior returns over time, as seen in past bull markets. The strong statistical relationship between gold and silver, with a correlation coefficient of 0.89 since 2000, shows silver's potential to outperform during gold's rallies. Analysts expect silver to reach $40 per ounce by mid-2025, driven by gold's recent all-time highs in 2024 and the typical 6 to 8 month lag silver experiences. More ambitious forecasts suggest silver could reach $50 by September 2025 if industrial demand and investment flows increase. Given silver's historical volatility, with daily price moves of $2 to $3 during breakout phases, there is significant potential for both short-term and long-term investors to capitalize on these price movements. That's it for today. Share your thoughts on Michael's analysis in the comment section below. If you find this video informative, don't forget to support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.